That was a whirlwind. We went through the national, the international economy, leadership, and everything else. And I will tell you, as much as I knew Rob Kaplan walking in here, I got more out of it and even more respect for him.
Well, I feel like we were on a CNBC fireside chat because he talked about everything. We went education, we went China, we went fiscal policy, monetary policy, his days at the Fed, and even what a Fed meeting looks like. We did everything.
And it was fun, it was broad, but you look at a lot of the issues, tariffs, et cetera. We went pretty deep in those. I think people are going to get a lot out of it from not only being interesting to listen to, but kind of an educational background too on some of these issues.
Well, it's neat. Rob also has a deep background in philanthropy and education. He loves these topics, and he's been a great asset to Dallas. We're very thankful that he's been here. But I think the listener is going to really get a depth that is unlike most podcasts are going to listen to.
And he's a national and international perspective, both in terms of his time at Goldman Sachs, but also understanding economic policy as the head of the Fed here, but also the participation in, as you mentioned, those interesting meetings around the big desk every 6 weeks.
He's done a lot. Welcome to Intersections, where we take a multi-generational look at the critical issues facing America. Tom?
Rob Kaplan today. Rob is a good friend. Interesting in terms of career. I was looking back at. So you got three distinct pieces. So you've got the finance investment banking, you've got the academia, and then you got public service. But what's more interesting when you go back through each of those three is the investment banking, the finance, Goldman Sachs, the premier firm, name, iconic image, etc. Rose to the management committee, ran Asia, ran corporate finance, pretty significant responsibilities on that. Then you look at the academic side, Harvard Business School, again, iconic, the high end of that. And then the public service, especially in the area of setting domestic and international monetary policy, as well as kind of overview on the economy's total, President of the Federal Reserve Bank. That's a pretty impressive career. Tell me, so you look back on that. What have been the big achievements that you've looked back on? What stands out in that career? Because again, so many different pieces, not only broad but deep. What stands out? What are you more proud of?
When I started at Goldman, the reason I started there is I love the markets. My father was a jewelry salesman and my mother was a real estate agent, but we talked about the markets from the time I was very young. And I concluded early that I would love to be in a place that was in the middle of the markets. So I didn't really worry about whether Goldman Sachs was the best firm. At the time I joined, we weren't number one. We're a good firm, but it wasn't. But I liked the culture, and I liked that we're in the middle of markets, and I love the markets. And I didn't worry as much, and I never have, about where it leads. And so I did well. Things went better and better and better. Business was growing in the 80s and in the 90s, and I just kept getting promoted until I was running investment banking, then investment management, and then sitting in the office of the CEO, overseeing a good part of the firm. And the one thing I would say, though, is I always loved coaching and developing people. I kind of learned that along the way. I didn't know it in advance. And so Hank Paulson, and others always gave me I chaired the partnership committee. If there were any people issues, I always led those, as well as running businesses, Pine Street Leadership Program. So that kind of led me by 2005. I started thinking about, I was in my late 40s, I don't want to just be a banker my whole life. And that led me to Harvard. And the Harvard situation, I thought I would do it for a year. Thought it'd be an excellent experience. Teach at Harvard. What a great experience. I'd learn how to teach the case method. Never, ever intended to stay for 10 years. But same thing, I enjoyed it. I learned a lot. I was helping people. The guy who was my unit head, Nithin Noria, became the dean. Then he asked me to consider staying longer and to be senior associate dean. Then I became a professor of management practice. And then I'd written articles, but they kept encouraging me to write a book. So I tried it and I learned I could write a book. And then I wrote another one and then another one. But I had no ambition to write a book. So I kind of made it up as I went. I enjoyed the journey. And then after 10 years, the Fed situation presented itself. I I did not want to move to Dallas from Boston, New York. I said no. But then I thought, man, do I really want to be one of those people who the rest of his life says, I could have done X, Y, or Z, but I said, no, that's no good. So I partners with a guy named Bill Draper in a venture philanthropy firm called Draper Richards Kaplan. I've been doing that for 15 years. And Bill said to me early on, life goes a lot better if you learn to occasionally say yes. And I always thought about that. And I realized, okay, I pushed myself to say yes, and I moved to Dallas. And with not a lot of expectations, I wasn't sure exactly what it was to be a Fed president, but I loved it and learned an enormous amount and had a great experience along the way. And then I certainly never intended to go back to Goldman Sachs. So that's the last thing I'm going to do. I was going to go run another business and reviewing options. But, I thought I'd recruited David Solomon, who's the CEO. I helped him recruit John Waldron to the firm. And I thought, you know what? What do I have a passion for right now? I want to help that firm. Whether I like it or not, Goldman's going to be associated with me for the rest of my life and after I'm long gone. And I think they need help. I think I'm uniquely in position to help them. And so I came back as vice chairman and part of the management committee, and that's why I came back. So it's not been planned or deliberate or calculated. I've sort of always enjoyed the journey. I've always followed my passion, and typically good things have happened when I've done that.
I've had a chance to sit in on some of your leadership seminars, and clearly you've honed a view of management and, more importantly, a view of leadership.
Yeah.
If you go back to those Goldman days, and again, pretty heady. You're right out of Harvard Business School, have come from the University of Kansas, so you're relatively young, but you're thrown in at that point by virtue of the firm and what they do in client relationships where you're dealing with very, very senior executives. Give us a sense of what you learned back then of kind of looking up, seeing management, and seeing the things that went right and didn't go right. What happened in those early years that really was kind of a foundation of the way you think of leadership?
So the fun part about the investment banking business, like a lot of industries you look at today, in the 80s and 90s, everything was new. Big mergers were new. Rate defense, pretty new. Leverage buyouts, brand new. A lot of elements of finance were new. And so we literally had to make it up as we went. And a lot of the practices today that are kind of like old hat, almost yawn, we had to make them up. And so the premium was on innovation, keeping an open mind, working well with others, because you can't innovate just by yourself, and teamwork, but also realizing, try something, might not work, try something else. And, don't get all hung up. And so there weren't a lot of boundaries or borders. And it was a fun time to be in the business. Business is a lot more buttoned up, structured today. So what I learned you can accomplish a lot more if you develop your team. You can be a big producer, you can build a business by yourself, but you're going to build a lot bigger business and accomplish a whole lot more if you focus a portion of your time on coaching, mentoring, developing your people, and taking ownership of them. The other thing I learned is number one piece of advice I always followed: do for others without regard to what's in it for you.
Servant leadership.
Do for others. Don't be transactional. Don't worry what you're going to get in return. If you can help somebody, jump on it. If that's a client, your people, but always put clients' interests first, but also help your people. Don't worry about what you're going to get out of it.
Do CEOs spend enough time on their people, on building them, building teams?
The best ones do. And those that struggle a little bit, if you look why they're struggling, it's often either they're too worried about the financial part of the business and not enough on the strategic. How do we add value that's distinctive? They don't focus enough on that. They're too worried about ROE and all that. I mean, good leaders worry about ROE too, but it starts with how do we add value, and or they haven't coached and mentored and taken ownership of their people. And so they haven't built the quality of team that would allow them to build a bigger business.
So how did you pick out the people, the men and women that you chose to mentor and to coach? Because you can't coach everybody, obviously. It's not enough time in the day. But how'd you pick those people out? What were the qualities, the characteristics, et cetera, that's shown to you?
So one of the things that happened to me my first year at the firm, they tapped me on the shoulder, at the end of the first year and said, we want you to work with the head of recruiting for investment banking and sort of be the gopher, And so I went to every school. I was involved in recruiting for the entire division because they needed a junior person to kind of do everything, all the stuff that nobody wanted to do. But what I learned from that is what it meant to recruit. Why did we pick certain people and not others? Who's a good fit? When do you take risk? And when does not make sense to take risk? So I developed early a pretty strong view of how you select people and what's a good recruiting process. And if you're going to make a mistake, what kind of mistakes are good mistakes and what kind of mistakes are not forgivable mistakes?
Were there any consistent hallmarks amongst those people that you chose to recruit? Did you ever create a framework for that?
Yeah. So number one, and this is me, take the best athlete. I don't care what a lot of people, they say, but he doesn't have financial or she doesn't have financial. I don't care. Take aptitude, best athlete, number one. Number two, I would never recruit anybody who, if I ask them, if things go well, would you consider staying here for 10 years? If the answer is no, no. Number three, tell me about what stocks you follow. I don't really watch the market. No. That you better love the passion. Yeah. Passion is the rocket fuel that drives high performance. If you're going to work in an investment bank, you better love the markets or else it's going to be tough. So there's certain basic questions you learn. And then the other thing I learned is I'll sit here talking to you. And even though we're talking here at one level, I'm getting a funny feeling about you that I bet you struggle with this. So use your instincts and ask, and you might tease out something either good or bad because you just get a feeling. You interviewed enough people. Same way when you work with clients or you coach somebody, you start to get a feel. They say they're this way, but you can tell they're really that way. You just develop an instinct.
One of the things I did when I was back on the CEO is I never let anybody hire a senior person unless they were in a social situation. In other words, bring somebody to a dinner, a lunch, et cetera, and see how they interact with the wait staff, not how they interact with you, but the wait staff, because then you really find out what kind of person they are. They can put on the face with you, but it usually doesn't carry through in, 2-hour dinner.
So here's the last one comment. When you're in many types of businesses, there are moments there's a lot of pressure. If you're in a business of any significance, there's going to be a lot of pressure. And I always used to say to people, and I still do, and I used to watch this, I don't care that much what you do when there's no pressure. When I'm paying attention and your people are really paying attention. Under pressure, when we made a decision, it didn't go well. There was an adverse situation. Then what do? Do you blame others? Do you protect people? Do you keep your cool? Do you do the right thing? Or do you sort of get people like you thought you know them, but they get very odd under pressure where you see they maybe don't do the right thing? I learned you want to watch in that very small percentage of the time when people are under pressure, what do they do? And I've been disappointed with some very well-known people, superb, where I've been with them in a pressure situation. You realize under pressure, you want to be careful because they won't do the right thing. I always try to do the right thing under pressure.
One more item here. Were there any people that mentored you? Were there any people that were...
Lots. Okay.
Give us some
early. So early in my career, and I was just talking about this the other day, early in my career and early in your career, senior people mentor you. Mm-hmm. Okay. The senior people are watching you. So Hank Paulson helped me. I can go through a guy named Bob Hurst, countless people helped me. Then you get to about 7 or 8 years in where you're getting more and more responsibility and you realize, and this is a very important thing for people to realize, your best coaches are no longer senior people. They're not even around you. They're not watching you. It's your subordinates, your colleagues and your subordinates. They're watching you and they become your best coaches. And I would say overall, the best coaches of my career, including today, are people who report up to me or junior to me, who I go to for advice constantly, because you want to get advice from people who observe you. Everybody talks about mentoring. Mentoring and coaching are not the same thing. Mentoring, I'll tell you a story, you give me advice based on the story. I'm interested in coaching. You observe me. All of us have blind spots. So my story is going to be distorted. If you see me in action, you're going to, I know your story is this, but let me tell you, here's what I saw you do. And I went, oh my God, I didn't realize I did that. You know, we all have blind spots. So you want coaching from people that observe you later on in your career. That's your subordinates.
And you want to judge people. Can they take on that coaching? Can they absorb the critical expertise and the critical comments that come with it?
Listen, the most biggest mistake that leaders make, you know, the biggest criticism of a leader, he or she, he doesn't listen, she doesn't listen. And the CEO says, I don't know why people say listen constantly. And then you watch them and you realize, okay, here's what it is. When somebody gives you that criticism, your first instinct is to rebut it because you like to win. You get a little, defensive. Defensive. Yeah. Don't. Ask a question. Try to understand. As a leader, when you rebut somebody, you shut them down. Takes a lot of nerve. For people to come into my office today and give me a criticism, they probably were thinking about it for a while. It takes a lot of nerve. Draw them out. Make sure they know you appreciate it. And then they'll keep coming, and you want them to, but too many leaders, to your point, shut them down.
Goldman Sachs, again, name that's recognized. The hiring is always in the Wall Street Journal. The partner selection is always in the Wall Street Journal. The leadership is always in the Wall Street Journal. When you think back to when you came in directly out of business school, kind of think of Rob Kaplan then, and then think of the people that Goldman Sachs is bringing today. How are they different? How has the generations changed?
So the biggest change is for starters, the size of the firm. So when I joined, I forget, maybe we were 3,000 people, something like that, mainly New York, not much of a footprint in Asia or in Europe, not even in London. Today we are in the neighborhood of 50,000 people, over 50 billion of revenues. It's just a dramatic. So, and the quantity of people we're hiring is much more. Also, the mix is different. So primarily when I was recruited, you either could do sales and trading, you could do investment banking, or you could be a private wealth person. And so those are pretty, that was kind of and yes, we had operations and others, but today we're hiring, interestingly, much more. We're hiring huge quantity, much more from undergraduate than we were. Interestingly, not as much from MBA schools and graduate schools as when I came in. And the reason is I think went for a number of years where MBAs, and I taught for 10 years, they didn't really want, their first choice wasn't to do investment banking as much. Some did, but they wanted to be entrepreneurs or go to other businesses. And so or they still would go to McKinsey. And so I noticed we do more undergraduate, we do more analyst promotes than we did. And we have a much broader range of types of people. We have thousands of engineers at the firm, technology people we just never had when I joined.
Values, work ethic, those sorts of things, that any different than it was decades ago?
People like to say, oh, this younger generation. Let me tell you something. My experience is, yes, this generation is much more technology savvy. They have many more very different characteristics. However, we attract people, in my opinion, who believe in the business principles. Clients' interests come first. Teamwork, mentoring, coaching. Our people, and I see thousands of people in the firm because I teach leadership courses in between client meetings. And let me tell you, they have signed up. They've drank the Kool-Aid. Then the trick is for the firm, in a much bigger firm, do we deliver it? The other change is when I was a 28-year-old associate at the firm, there might have been 3 or 4 people at the firm who were older than 55 years old. Today, we have at least over 1,000 people who are old, so much older. We just celebrated what we call the Quarter Century Club at Goldman Sachs this last week. I think there were 375 inductees. Okay. I mean, so people are staying at the firm longer. Mm-hmm. So yes, you have turnover, but people are staying at the firm longer, and it's more typical to work into your 50s and 60s than when I grew up in the firm.
Like a McKinsey, do they have mandatory retirement?
We do not, and I'm glad we don't. This is an experienced business. I mean, I look back on my career now, I am so much more effective and better at doing things that when I was, running investment banking division. My Lord, I wish I knew then what I know now, or had the temperament, the maturity. I didn't really have the I was too young, didn't have the temperate maturity and you get better in this business as you get older. It takes a lot of energy, but you get better.
After that comment, it's going to be difficult to have people that you can convince that you're still 39. Yeah. But we'll let that go aside for a second.
So talk to me about the recruitment. It seems like y'all have expanded out the map too in the United States.
Yes.
So the history, let's say, looks at the Ivy Leagues and the Northeast schools. But, I've had a buddy this week who actually just completed training. He's from Baylor University.
Yeah.
And he's going to be an intro analyst, kind of intern this summer. Yeah. So talk to me about the map. How's that changed? Texas, SMU, et cetera.
So let's go through. We've got more than 10,000 people in India. I just did a leadership session for our senior leaders in India. I did it yesterday morning when I was in Atlanta. I did it remotely. We got more than 10,000 people there. We have thousands of people in Europe. We have a very sizable Latin American presence. I used to run the Tokyo office, Hong Kong. We have thousands of people in Asia, and our franchise is dramatically more developed. We did not get into the asset management business until probably after I'd been at the firm. It's probably 17, 18 years, and we were just getting started, and now we have a dramatically more built-out asset management firm that's global. We have a long way to go, but we've made enormous strides. So, but this is a globally distributed firm, much more geographically sprawled. The New York office today, I'm guessing, has, say, 9,000 people out of 50,000. That would have astounded me 20 years ago. So that's a little less than 20% of the firm. We're approaching 5,000 people in Dallas. Okay, so we're much more geographically distributed in the United States as well as around the world.
Yeah, and you've got a new headquarters.
We are, and we're just waiting for the building to get done.
Yep. Yeah. So Kyle, take that a different way. As not just at Goldman, but as the vice chair of a major international firm, you look at the administration today. Trying to restrict international students coming in, immigration becoming much more difficult, those sorts of things. From a corporate standpoint, corporate leadership standpoint, what do you think that does to the competitiveness of American firms and the competitiveness of the American economy longer term?
So what's made America great? U.S. exceptionalism. What's that about? Higher education, great universities. We rank very highly globally. Mm-hmm. Especially our great universities. We're a magnet for talent. We're a magnet for innovation because we've had a greater pool of money for, as you well know, because you spent a lot of time on it, for medical research and biotech research and other research. We are a magnet for that talent here. And that talent migration has been essential to the United States as well as predictable rule of law. We abide by our agreements, free speech, and debate, open debate and disagreement. We're not afraid of it. And so the courts are effective and are respected. That's part of the institutional framework in the United States that helps every company, in my opinion, that's here and is allowed and encourage global capital to come here. And also U.S. pools of capital want to stay here because it's not that easy to find those combination of features. If we fray those and you lose talent on the margin and it's harder to attract capital, it'll have a negative effect, a more challenging impact on the quality of U.S. businesses, which we all benefit from.
Do firms like yours then start looking elsewhere to bring in that talent? If it's not going to be able to be here, do you start growing other locations?
So we hire all over the world. I actually think Goldman Sachs will be well positioned to hire that superb talent all over the world. I'm a little bit selfishly more worried about the United States. Listen, I lived in Asia and I ran Tokyo, and I saw Japan's a country got many great qualities. However, it's got an aging population. In fact, it's shrinking,
Demographics are
and
terrible.
it's not culturally open to immigration. Right. Germany is not as culturally open to immigration. It affects their growth. It affects dynamism. It affects all the elements, and they're struggling with those things. We have enormous competitive advantages here, and it's very critical. Like you work with a company, recognize what your competitive advantages are and build them. We have enormous competitive advantages. It pays to recognize what they are and enhance them. And we may be at times getting away from that here.
So after Harvard, after Goldman Sachs, take on the president of the Federal Reserve Bank in Dallas. Talk a little bit. It's a fascinating position to me because in one sense, it is a bank president. But in another sense, it is an advisor at the highest levels on monetary policy in the United States, monetary and economic policy in the United States. Walk us through a little bit of kind of all the different pieces of that and what a unique position it is.
So there is, on the one hand, an operating role. And because of my background, I think the Fed and the leadership of the Fed gave me more operating roles than maybe other. We have 1,300 people in Dallas. You got 21 or 22,000 Fed-wide. Huge technology effort. And so they had asked me to chair the committee that oversaw technology and also chaired the committee that did all budgeting for the Fed because I had that background. And so they welcomed me to do that. I think the most important change that I had to make, ironically, the Harvard background was far more instrumental for me taking over the Dallas Fed than the Goldman background. So why do I say that? The Fed is run predominantly by PhD economists. I managed a senior assistant. I learned how to manage academics. What is that? It's a much more participative management approach. What I mean by that is you learn to share information, seek advice, get buy-in. In business, you can be more directive. In academia, you have to be more participative. The Fed's an interesting combination of it in that most Fed presidents, your entire research department, which we had one in Dallas, but we have them all over, they're all basically PhD economists. You can direct them what to do, but you're not going to get very good results. And I've seen previous presidents do it. I don't want to do that. What you have to do is you have to engage with them, read their papers, debate with them, prove that you can learn everything they know, show them respect. If you do that, and I found this at Harvard, they will in turn show you respect. And so I think the most important thing you do as a Fed president is try to have a theory of the case on what's going on in the local economy, the U.S. economy, and the global economy, and what do I think their policy implications are. And you need a strong team to help you in order to do that.
You talked to the cultural identification, but the reality of it is, and you really saw a big shift once Biden came in, back to the academia. You were one of the few people that, though, understood how markets worked. I mean, you had lived your life understanding how those markets worked. That had to be an enormous asset, not only in terms of the Dallas Fed, but your participation in the Federal Open Market Committee, the conversations that take place, quote, at the big table, et cetera.
Yeah, having a business background is an enormous advantage because you can learn the academic part, and I studied it intensively. So I always talk about, and you've heard me talk about the difference between structural drivers and cyclical developments. PhD economists tend to be drawn more to cyclical developments. Why? Because those generate data. Okay, if you want to write an academic paper, you need data. So there's a tendency, all this Commerce Department data. We had a jobs report today. PhD economists tend to hoover up data, and then you put it into a model. Business people, whether you realize it or not, we look at data too, but we also focus on drivers. What are the drivers of a business? And so I tended to use that framework in the U.S. economy, where I look at drivers. And even today, when I go on television, also, I'm talking about structural drivers. And that is less typical of people around the FOMC table.
And that, again, a big advantage, because especially over the course of, let's call it the last 15 years, a lot of that academic, of which is taking that data and understood what in the past and then apply it to the future, that didn't play out at all. It didn't play out in the 2008, 2009, because you had a very different situation that wasn't recognized by the data. We came into the COVID situation, very different game. And even coming out of that, where all of a sudden, when you expected softness to come in durable goods, that was actually the strongest part. It was services that got weak, which is reversed.
Right.
So having that different perspective.
So here's a good example. So yeah, COVID is an example of an enormous structural change. Okay, the other huge structural change, which people didn't focus on as much as they should, the government authorized $6 trillion of extraordinary spend. $2 trillion CARES Act, $2 trillion American Rescue Act, $1 trillion Inflation Reduction Act, $1 trillion Infrastructure and CHIPS Act in a $27 or $28 trillion economy. Is that a lot of fiscal stimulus? Yeah, that's a lot of fiscal stimulus. And monetary policy needed to take it into account and step down. And that's why you may remember in the fall of 2020, I was dissented and was vocal dissenter for a while there, because I felt monetary policy needed to start to take our foot off the gas and back off, because fiscal stimulus was so substantial. And unfortunately, what happened is we had the years 21 and 22, you had your foot floored on fiscal and your foot floored on monetary, and it produced an extraordinary inflationary response.
So in retrospect then, did we throw too much money at the situation?
Yes. And by the way, in fairness to our team at the Dallas Fed, we called it out in the fall of 2020, not without a lot of controversy. And we kept arguing we need to take our foot off the accelerator. We need to be talking about tapering. The Fed bought bonds for a year, 15 months too long, and was probably a year late in starting to seriously look at raising the Fed funds rate.
That never did reverse. I mean, that took a long time to reverse.
We are still, even today. So I always talk at the Fed, and I used to talk to my team, there's two types of mistakes. One you can make, one you can't. There's a tactical mistake, which you don't love, but you can live with, and there's a strategic mistake. Tactical mistake is we're late by a meeting. Okay, fine. Guilty as charged. We'll fix it. But we can fix it in the next meeting. A strategic mistake is you're off course, you stay way off course for too long, and it takes years to fix it. That's a strategic mistake. I would argue keeping rates at zero and committing in the fall of 2020, we would keep rates at zero and we keep buying bonds until we hit full employment. That was a strategic error, which why normally I don't like to dissent, but I had to, because I thought that was a strategic error. Now, I would argue if the Fed had jumped in this spring to cutting rates before letting this tariff situation play out, that would have risked a strategic error, not a tactical error. I mean, the Fed may turn out to be late. If it's late, inflation is a dog that didn't bark, fine, we'll lower. It will live. But if you were wrong and you jumped in, it might take you a year or two to fix that mistake.
So take us into a Fed meeting. What's it like? How's it work? Tell us about it.
So the FOMC meets every 6 weeks, therefore 8 times a year. You show up on Monday. Usually we'll have committee meetings.
Well, and it's made up of the 12 Fed presidents are sitting there.
And seven
vote and 7 governors, but not all the Fed presidents.
So let's get to this part, and then we'll talk about what happens with it. Every 6 weeks, 8 times a year, you show up on Monday, committee meetings among the 12 presidents, okay? And we'll usually debate supervision or other issues. Tuesday is a meeting of everyone, all 12 presidents, 7 governors, you around the table. Each of us has 10 minutes. and we will each give our presentation on what we think is the state of the U.S. and global economy. And we'll give and I try to bring every meeting some insight that maybe nobody is going to, like, for example, about the energy business, given we know more, or trade, because we're uniquely positioned here. Wednesday, and we'll get to the voting, Wednesday is you each talk for 10 minutes about your recommendation on monetary policy. Now, there are 12 votes of the 19. At the head of the Dallas Fed, I vote every 3 years. And so even if whether you vote or not has no impact, in my opinion, on your influence in the meeting. However, in the last 30 seconds of the meeting, after you've debated, we vote, there's a decision made, and then there's the press conference. It's put out at, 2 o'clock Eastern time, and there's a press conference half hour later, and that's the structure of the FOMC.
There's a story that the chairman really carries it. And that there was the Volcker story of he was going to get outvoted and then basically said, if you outvote me, I'm done and I'm going to go. And the votes changed. Any other situations like that where the chairman was either outvoted or in danger of being outvoted?
So normally, the chair's job is to get the consensus of the group and try to find that consensus and then position himself there. The only time I saw, and that's what I saw Janet Yellen do, and the only time I saw Jay put his thumb on the scale was on back to the fall of 2020, and on we're going to keep rates at zero until we reach full employment, and also that we need to keep the bond buying going and commit to it. That would be called forward guidance. I think he felt very, very strongly that we needed to do this. And so then what has happened when you're on the other side? I told him I can't go along with this. And he said, okay, he would try to convince me. Mm-hmm. And then I said, I'd say to him, and we had 10 or 15, literally a lot of conversations. Okay, I'm going to try to convince you. By the way, I think you're making a mistake. It's bad for all of us, but I want to convince you. And we went back and forth. I think one of the problems was, remember, we're in the middle of COVID, so we were remote. I think if we'd not been in the remote situation and I could have been with him and the others in person, I still believe I would have convinced them to make a different decision. Okay, so now the other thing I would say to you is most Fed presidents and governors go into the meeting usually have a call with the Fed, with the chair on Thursday and Friday the week before. Okay, he talks to half the participants on Thursday, half on Friday, and you kind of tell them what you're going to do. When we got into that meeting, I can tell you, is my view, we were remote, but I think some of the people, if they had a do-over, might have felt differently, but they had made a commitment the week before, had already made up their mind. Yeah. And so that's why if there were one reform to the Fed that they did adopt at the Bank of England, have a day where there isn't a transcript where you can just debate it out about your views of the economy, then start the formal meeting. And I think that might help in those situations that I'd like to hear everybody else's views. They can hear my arguments, and some people will change their minds.
Inherent in everything you're saying is the Fed getting a group of people who are focusing on their dual mandate alone, both full employment and stability in the monetary side of it. And they're doing that for the good of the country outside of any political interference.
That's
in fact, going back to 1913, that's been a hallmark of our Federal Reserve System.
I agree.
Recently, however, the president has not only questioned that and put pressure on it, but has also identified the chairman with words of loser. It's a whole host of different words like that.
Right.
How important, Rob, is that independence, and how worried are you about it right now?
So on setting the federal funds rate, that independence is critically important. And on using the emergency powers of the Fed, like with the balance sheet, also critically important, because we had to do a number of unpopular and controversial things, but we had the power to do them. And if you put it up to a vote, you might not have been able to do them. Interestingly, sitting inside the Fed, because I remember I was there for the entire first term of the Trump administration. Did his jawboning affect anything that I did or we did? No, it did. It did not. It honestly did. I think it created more stress on the chair because he wanted to be reappointed. It was his first term. Mm-hmm. I think reappointment meant a lot to him. Ironically, as we sit here today, I also think that the presidential jawboning is having no effect on Fed decision-making, on the Fed funds rate. And Jay is in his second term. He's been through a lot more. I think he's a lot more confident. He's had, I think, with maybe some things he'd like to do differently, but by and large, a successful experience there.
And up in 2026.
It is up, and he will step down in middle of next year, spring of next year. But I think the one reason why it's possible the Trump administration did not even go very far, and I don't think they're going to, replacing Jay Powell, is even if you replaced him, the Fed isn't going to cut rates. Why? There's no consensus to cut rates. And again, you need 12 votes. Maybe you can suffer 3 dissents, but you could have a new chair. If I'm running the Dallas Fed, I'm hell-bent to do what I think is right. And I'm not going to be influenced by a chair. And I'm definitely not going to be influenced by a chair if I think he's worrying too much about political considerations, because I firmly believe we're not supposed to do that.
But today, if you look across the world, you're seeing most central banks are starting to move towards reducing the rates. We've seen it in the last week. I think we've seen Canada,
talk about why.
UK, EU, et cetera. Go.
So it's interesting. And I would argue if we did not have this tariff episode, Fed would be cutting rates too. So here's
is a stand backish type of thing and wait and see?
No, here's the issue. Well, the issue is, remember, and you alluded to this, Beckford, goods for the last 2 years have been disinflating. Durable goods are deflating. Non-durable goods, the inflation rate's probably 1%. So goods are not been the problem. Services, because of, I would argue, excess fiscal spending, have been the problem.
Which is a big flip from coming out of COVID.
It's a huge flip in that COVID started as a supply chain issue. I think it morphed into an excess demand issue because of too much fiscal spending. So as we sit here today, goods globally are disinflating. There's only one place in the world that we're being shielded a little bit from that disinflation. The United States. Remember, the rest of the world has a trade war with only one country. We're the only country in the world that has a trade dispute with every country where our manufacturers, I mean, I've got to increase prices because there's nowhere to turn. And so we've been arguing, and I've been arguing at Goldman Sachs for the last number of months, yes, you're going to see divergence between the ECB and the Fed because they have a disinflation situation. The path is clear to cut rates. We're a little stickier, I would argue, than we might have been because of the tariff situation. But that divergence will end either by the end of this year or early next year, in my opinion, after even these tariffs in the low to mid-teens have run through. And the world, ironically, is still on that, from a goods point of view, is we've got enormous oversupply. The only danger in the United States, if we put a tourniquet on goods, we may be artificially stand in the way of that disinflation.
And imports are roughly 11% of GDP.
That's right.
So it's not 50.
And manufacturing is 12%. Okay. So, but let's finish that. That's 23%. That's another argument why substitution goods, services for goods. I don't know if the inflationary impact ultimately is going to be as severe as people are fearing, but the Fed has to wait to find out.
That's what I wanted to ask you. I'm going to jump in here. I apologize. It's an area you and I have talked about before. And to unpack the tariffs, I think it's important. And you talked strategy and tactics. So let's talk about direction, rationale, and then we'll talk about how it's done, because I think there's a different question. Clearly, the administration is saying, we need to do this now because the feds, I'm putting a little bit of words in their mouth, have gone for decades and gone to a zero rate environment that those who in the economy own assets do very well, e.g. upper 10%. However, the middle class or the middle income,
that's right,
which is declining, they've seen fundamentally flat wages for the last 40 years,
right,
plus or minus. So they have been the losers in a zero rate economy. And we've seen manufacturing go away. Those jobs have gone away. That's one of the reasons for the flat tax. So we need tariffs to fix that.
Right.
Talk about that rationale. And then if tariffs aren't the right way, talk about how do we deal with that inequality in the economy.
So let's take it in pieces. First of all, what you just said, Tom, is absolutely right. There are upwards of 75, 80 million workers in this country that make 55 grand a year or less. And they have one thing in common. They've lost 25% purchasing power, and they are struggling to make ends meet. I can tell you, because I talked to a lot of them, they're angry. If they're physically able, they're working 2 jobs. They work heavily, though, not just in manufacturing, they work heavily in the service sector. Mm-hmm. Okay. While that's going on, manufacturing share of global GDP is steadily declining. Okay. So, the trick for the United States is if you're going to increase manufacturing and create manufacturing jobs, you want to prioritize high value added manufacturing, not sneakers and tennis shoes, higher value added. And the other thing you'd want to do, and that means you might not have a trade war with Vietnam because it's lower value added, and you want to protect Mexico and Canada, because that allows U.S. companies to domicile here. Remember, made in America doesn't mean 100% made in America. It means heavily, predominantly made in America and assembled in America. And cheap labor in Mexico and cheap resources from Canada allow the U.S. to take share from the rest of the world.
And those two are our first targets.
That's why it was confusing. And so, listen, I think we'll get some reshoring here, and we'll create tax incentives for reshoring. The type
that you're talking about, that takes years. I mean, building a factory is not something you do overnight.
And you would be selective. You want to bring back, again, so would you try to recreate the lumber and aluminum industry here? I don't think so. You would continue to buy it up north. And so the only issue has been, and I can go through why I think they've done what they've done, you would have prioritized more. You would have segmented. You wouldn't have declared war on 100 countries. You would have prioritized 4 or 5 or 6 and bored in on it. And they didn't do that. So why didn't they? I can tell you why I think they didn't. The DOGE cost cutting for the federal government has not come up with the savings they hoped. Remember, they talked about $1 trillion.
$1 trillion.
They had to get the revenues out.
I think they want the tariff revenue, and that's why they're negotiating with Japan. You notice they haven't made a deal with Japan yet. Why? Japan came aggressively and very aggressive offers, and that we've said to them, great, thank you. We're going to charge you 10%. And Japan has said, I'm not going to do a deal at 10%. Well, nobody's going to get less than 10%. We don't want, and so they haven't. You sort of have bid ask is a little bit stalemated, and I think it's because we want to maintain $300 or $400 billion of tariff revenue, which will make it easier to at least psychologically pass this tax.
This big beautiful bill.
I think it may be part of it. Yeah.
Do you see then that 10% number kind of being negotiated potentially once that big beautiful bill gets passed?
I'm not smart enough to know. But I think in our best guess at Goldman, our estimates are that the average tariff will wind up be low to mid-teens. Having said that, and you're going to have a lot of fraying, and we see it all around the world, and I travel a lot to businesses around the world and institutions, it's creating strained relationships around the world, and as well as other things that are going on or contributing to that, geopolitical and otherwise, decisions we're making, Ukraine, Russia, a lot of sensitive areas. But I think they want the revenue.
So take me back to April, Liberation Day on the tariffs. Why that day? And then why all of a sudden the massive pullback in a lot of ways for a lot of the countries over the last, call it.
So comment on the tactical side of
why'd they do it that way?
So they're different. So this is where you have to take some liberties to make some projections. I think the thought was, I'll start high, you start low, we'll meet in the middle. Okay. The issue is, how long does it take to negotiate a trade deal anyhow? The fastest you're going to do I know we've looked at this a lot. It takes at least 15 to 18 months to do a trade deal. They're very complicated, enormously detailed. And these trade negotiators around the world are highly sophisticated. So if you would say maybe if there was a desire for a do-over, you can't possibly do more in even these days other than do a term sheet. 100 trade deals is an enormous amount. If you had again prioritized down to 3 or 4 or 5, that would have been an enormous challenge, and we'd be working on it for 15 months. Here's what I think is likely going to happen. If I had the instinct, the Trump administration is going to ultimately set the tariff rates again in July. I'm assuming they're going to be much lower than Liberation Day, and they're going to say to these countries, let's keep talking, but here's a placeholder for where the tariffs are going to be while we talk. Sure. And it will be uncomfortable, but I think this administration wants very much to put a bow on this tariff situation and push it a little bit more behind and focus more on regulatory reform and getting the tax bill done.
So for a second, just talk to me about the tax bill. Let's say the tax bill doesn't pass.
Yeah.
Then what happens? Because at that point, in my view, you've got a little bit of an economic shock. You've got the tariff situation going on, and if that doesn't pass,
I don't think it's worth putting a lot of energy in debating whether the tax bill doesn't pass, because I think they're going to put every ounce, and they are putting every ounce of
they have to.
Pressure.
Agreed.
To the unfortunate thing is we started the year with a view that it might be painful, but we're going to start to inch down and chip away at these 6.5%, 7% of GDP deficits. Right. And we're going to start inching down to more fiscal responsibility. It's not going to happen.
But that's where we go. So that's a piece. But I want to get Rob's view on the longer term. So we are sitting with all of the things that you've talked about in the last years of throwing money at it. We're sitting roughly $37 trillion in debt right now, 75% of it domestic, 25% of it international. Just came out with the latest estimate that this bill will add another $2.5 trillion plus or minus. That might be high, that might be low, depending on growth. But it really becomes a big number. As you and I have talked about, the off-balance sheet number is well north of $150 trillion.
Present value of unfunded entitlements.
Yeah. Oh, yeah.
So first of all, Rob, people get these numbers thrown at them. Why should they even care about what the debt of the United States is? In other words, what bad can happen?
All right. So let's just go through. Let me just take that out of the way. What's the next year likely to look like, and then what's the tail risk? And I would call this a tail risk, meaning it's an extreme outcome, may or may not happen, but we're more vulnerable to it. I think the net of the tariffs, the tax bill, what we're doing on immigration and dramatically curtailing it, we're running a very tight labor force. I've been saying now for a few months, I don't think you're going to see unemployment go like this because the labor force is tighter than everybody realizes because we've curtailed immigration so substantially. Okay. I think you're going to have sluggish.
So the 4.2%, we kind of stay there regardless.
I think we can stay in the neighborhood. It might drift up a little bit. It's not going to spike up. Okay. The Fed 3 months ago thought, man, it's going to spike up. And then we're going to have to maybe take some risk. I think that's less. I think it's a little less like because the labor force is so tight. And second, the tax bills. We thought it's going to be contractionary early in the year. Now it looks like it might be stimulative. So I think the net for the next year is sluggish growth, but not a recession. Low unemployment rate. Corporate earnings. Interestingly, there was a lot of worry in a recession. They'll be down 10%. We think corporate earnings will be up 5, 6, 7%. Not spectacular, but solid. Mm-hmm. Stock market might do reasonably well. Mm-hmm. Credit spreads might stay reasonably tight. So what's the issue? The issue is duration, tenure and longer. We've got, as you just said, $37 trillion on its way to 40. And the problem is, we are struggling, even before this administration came into office, we were struggling to sell duration. And we had front end load, remember? And I think this administration understandably has kept that. I think we're going to have to keep rolling. I think, so what could help? So the danger is if you keep running 7% deficits, that's a nice way of saying debt growth is growing faster than nominal GDP,
which has clearly been the case,
and it's going to. It means it's going to continue. So, what could help us? What are the two things that could help? One is the X factor is we get a surprise positively in productivity growth. So in other words, we even with stagnant workforce growth or very disappointing workforce growth, you get productivity growth through AI and other things, and you're running a very tight labor force. So yes, people get disrupted out of their job, but maybe that's offset by the fact that retirements and you've got to do a better job than in education. We talk skills training, getting people repotted, but maybe if you can grow higher because of productivity and find somehow a way to grow 2.25%, even though labor force growth, then you're highly leveraged, but debt to GDP kind of hangs in there.
So what's your short-term outlook on inflation the next year? Good overview of the next year on all the pieces at inflation.
I think there is a chance, and I don't know, and I'll be the first to say it, and you want to be a risk manager here, not a prognosticator. I think it's possible because goods are only 24% of the economy, we just said, that dynamic substitution, the fact that goods are disinflating away from the U.S., that maybe we'll get to later this year and say, lo and behold, I don't know how, but PC inflation's more muted than we fear.
Still in the 2 to 2.5% range.
We pressure, companies are telling me, I'm going to pressure suppliers, I'm going to take some out of margin, I'll put some in price, I may not do it all at once. And so if that happens, and we still think we're making progress, then the Fed will later this year, and maybe late this year at least, be prepared to start inching down the Fed funds rate.
Right. But does that work?
That'll do one thing I just want to sneak in. Yeah. What that does is it makes it not costless to be hanging out at the front end of the curve anymore. In other words, it starts to give people an incentive to taking some risk and buying duration.
But if we get some inflation and low growth, so stagflation as talked, should we be worried because the Federal Reserve, the tools that historically have been used, the ones you've talked about, rates, are they going to be as effective given the duration you've talked about and the fact that the proportion of debt, which was really a household and a corporate, and then fed down here, now it's shifted. So all of a sudden, it's the federal debt that's the big chunk with a much smaller proportion being household and corporate. Do they still have the tools to be able to affect the economy the way they used to?
So my view very strongly, and I said this many times when I was the Fed, is this issue, just economic management, Fed plays a key role, but it's just a role. I would argue even on it, fighting inflation, Fed plays a key role. But for those who say it's up to the Fed, not completely. You need economic policy.
All the fiscal policy throwing money at it.
Including education policy, immigration policy, all of it. And to your point, as you point out, if the term premium inches up, even if the Fed is cutting rates, that creates a tightening of economic conditions at a time where the Fed's trying to ease economic conditions. And so the thing we've got to be very concerned about, which is why I really hope Congress gets back to, whatever we do on this bill, get back to this looking at entitlements, means testing, other things, because what you don't want is the term premium keep inching up. We get more and more leveraged, and it squeezes out and creates a tightening on financial conditions, which really is undesirable.
Well, when did the creditors start calling in a certain sense? I mean, when do you start see, you saw another downgrade, I don't know, 2 weeks ago.
Yeah.
When does that happen? When do they start coming to us and saying, hey, we're going to, we want to see higher interest rates on what we own of yours? Does that happen?
Well, I think it's already happened. Okay, here's what I mean. January 1st, 10-year Treasury was 4.50. Our estimate for GDP growth, as we sat January, was 2.25%, 2.5%. As I sit here right now, our best guess for GDP growth is 0.75% to 1%. Dramatic disappointment. Where's the 10-year? 4.40. It's a little under where it started the year. I guess in the past, if you told me GDP growth is going to go from 2.25% to 2.5% down to 1%, I would have told you you're going to see a rally in the 10-year. Right. Haven't seen it.
Yeah.
That tells you we're already paying.
Yeah, we're feeling it.
There's a rate impact. You're already seeing it. Now, the danger is in the years ahead, through a catalyst you can't predict, maybe you're going to see it more.
Back to the productivity increase, it seems like a little bit of a bank shot to kind of, hope that happens. I mean, you've got a little bit of a declining population from the baby boomer situation. Talk to me about how you see the AI, the new wave of the economy.
So in fairness, we are doing a number of things in the United States that will help productivity. We'll get to education, which is one area we're not doing enough. But you got enormous AI investment, just enormous. The Mag 7, but broadly, you can't talk to a company here who's not spending on technology and AI because they have to. Number one, you are seeing, in fairness to Congress, they are trying to create enormous incentives. The regulatory review that this administration has initiated,
taking the regulations down,
I think makes total sense in that they're trying to make it easier for industries to get the benefit of all this technology by regulatory relief and let you take advantage of it. So we're doing a lot of the right things. The negative is, I think we would do even better if we invested more in full day versus half day pre-K, daycare for at-risk families, skills training, more in the education system. And so one of the things we're also going to have to come to grips with, which is controversial, is an unacceptably high percentage of kids that go to college are not graduated even in 6 years. Some percentage of them should have gone for skills training first and then maybe gone to college or gotten middle. And so we are going to have to relook at our education ecosystem.
I'm going to tee up the education after this question. Going back then to this fiscal situation that we live in with the debt, is it fair to say that works? In other words, we more than any other country, because our debt ratios now are approaching countries that we never thought we'd be with, Poland's, Argentina's, et cetera, those sort of things. It works as long as you're the reserve currency. In other words, everything across the world is denominated in dollars.
That's right.
So that gives us a free play that the rest of the world doesn't have.
Yes.
But once we lose that, then does it come home to hit us?
It would hit us. And so, yes, the reason we get away with a lot of what we do is up to this moment, when in doubt, under stress, I want to own the dollar and I want to be in treasuries. This is why any administration, this one and any, needs to be so the right way to approach it is, I'd be on the one hand confident that we can remain the world's reserve currency for 20 years.
So you don't see a threat?
No, let me say, on the one hand, I would be confident about it. On the other hand, if I were in the administration and where I sit now, I would be running like a great company, scared, neurotic about it all the time, which means I want to make sure that I keep good relationships around the world. I want to make sure the institutional framework in the United States is intact. I want to make sure we're still a magnet for talent. I want to make sure we stick by our trade agreements and don't violate them. I want to make sure people have confidence in the rule of law. I think as long as the institutional framework stays intact. And the last thing is, while I'd love to build the crypto industry in the United States, don't go overboard with that, because the part of crypto that's detached from the underlying currency is deliberately why the motivation for it is they don't have confidence. It benefits from lack of confidence. Just be aware of that. And so the institutional framework staying intact, and that's why the situation with Harvard and rule of law and all those things I'm sensitive to, not because I care about Harvard and I'm on the board of the med school. It's because I think for the United States, we need to keep it intact to be able to maintain and push for as long as possible the world's reserve currency.
But to push on that, Rob, clearly we can talk about kind of the economic piece of the equation, which I think you articulate well. But then you got into kind of what I'll call for the second, the non-economic. And that's kind of the trust factor with the United States, e.g. the United States is the world leader. Well, now you've got us going after the EU. We talked about going after Mexico and Canada, in theory, our friends and our neighbors. We're pushing hard against nearly all institutions, NATO, et cetera, along the line. How difficult and how damaging is that going to be longer term of losing the trust in those institutions and with those allies that literally since World War II have been the framework for the entire world? So again, the economic can happen, our debt, et cetera, those sorts of things. But do these non-economic become even more important?
I would call this as all part of the institutional framework. NATO is part of the, and our role in it is part of the institutional framework. You know, when you call Vladimir Putin and you press him to do something, having a presence in foreign aid, having a good relationship, you can be tough, and fight, go ahead. But a confidence that these institutional framework will hold that you described, I think it actually makes those phone calls and that pressure far more potent. And I just think this has to all be looked at in a holistic mosaic where a tactical decision here, and here, you want to make sure as leaders, you want to factor in the bigger picture, which is we're highly leveraged. We need to attract capital. We want stability in the world. We want the U.S. to be able to play a role in maintaining it. And the institutional framework and the maintaining it, you may want to be tough, fight for your rights, fine, great, but don't do something that's going to make people, as you put it, you don't want to undermine trust. If I think you're tough to deal with, okay, I can live with it. If I think you don't stick to your word, that's a different subject.
Or you continue to move. So that begs then, we talked about some of our friends. Let's talk about somebody that's not necessarily our friend, China. And again, I think you're in an interesting position. You lived in Asia. You understood that market. You worked in that market. So China today is not only an economic threat, it is a military threat, increasingly so, especially in South China Sea relative to the Taiwanese issues. We continue to have that focus being the trade war with all these other things that we've talked about. But then on top of that, you look at China and say, growth is declining by any measure, and they're probably more vulnerable to a trade war. You also have a situation where their demographics, we talked about Japan's, I think they're following right behind it in terms of demographics and something you can't change over 40 years. Where do you look at China as a threat to the United States today and longer term?
So here's where I get nervous is when people talk about China in a one-dimensional way. They're a juggernaut that's a looming enemy, for example, would be a distorted view, in my opinion. So let's go through. There are three tracks with China. There's the, cyber and potential threats where you've got to be very tough and we have to be very aggressive in defending ourselves. There's the part where they're a competitor, where they're investing around the world and they're trying to do deals around the world and change the world standard away from the United States to them. Mm-hmm. But there's a third channel, which is vital, where we're inextricably linked. And their interests and our interests are highly aligned. Our farmers need their markets for goods. We need their rare earths. It is not in our interest to seize China's economy falter. It is not in their interest to see ours falter. And to your point, they're far weaker and they have bigger problems. We have a demographic issue, theirs is worse. We have a leverage issue, theirs is worse. They have enormous
when you say leverage, you're talking property markets, debt, things like that.
They have enormous manufacturing overcapacity. And the reason why the administration rightly de-escalated things a few weeks ago, and Scott Bessent rightly said, we both agree it's not in our interest to decouple, it's because it's not. The rhetoric politically gets distorted. It is critical that we maintain a constructive relationship, and their interests and our interests, there is a lot of alignment. And the danger is if we turn them into a caricature where it's all adversary. Yes, there are parts where we've got to be very tough. They're a competitor for sure, but there are parts where we need to collaborate, cooperate. We want to have a constructive relationship. You don't want to see their economy unravel. And they don't want to see ours unravel, and we are mutually dependent. 40% of the imports from China are intermediate goods in the United States. And so that's why I'm actually optimistic. I think people will be surprised that we will come to a constructive agreement with them that might surprise people. Now, people like Japan are watching that and say, what about us?
Yeah.
Why aren't our deal with us better? I thought we were a closer ally, and we'll have to work that out.
Do you think a deal with
And with
China?
Japan putting a lot more money in military.
Do you think a deal with China is a signal, or do you think it's an outlier because of so much coupling that goes on from a deal perspective?
I think a constructive deal with China is essential to the United States, and it's essential to China. And I'm confident we will get there. At the same time that we're taking a very tough stance with them on cyber, making sure we're on guard militarily and all that. We can walk and chew gum at the same time.
We talked about some of the areas, Rob, that you clearly have been an enormous success and contribute to the economy in a lot of different ways, from the corporate side to academia to the public side as Federal Reserve. Two other pieces people don't understand, and you mentioned a couple of them, sitting on the board of the Harvard Medical School, the philanthropies you've done. You've been enormous in terms of philanthropy. But the other area that I know is passionate to you is education. And you've talked about it today in a lot of different ways. Goldman, dependent on getting good people. You talked about advanced manufacturing in the United States, dependent on getting good, educated people. And we can go on and on. With all of that importance, then I flip it back to you and say, here in Dallas, we've got roughly 35% of the kids that are at grade level. 65, 70% are below grade level.
Yeah.
What does that say long-term for our nation? And what do we need to do in education to kind of right the ship and give ourselves a chance to succeed?
So, I'm involved with two organizations. One is called, I've been on the board of Commit for close to 10 years that works locally, and I'm on the board of an organization called Holdsworth, which is the Butt family started it, that educates superintendents and principals in the state of Texas.
Yeah, and that's the HEB family.
It is, and I've been on the board of that for several years and teach there. And so here's the challenge, and why is education so tough? And I did a lot of work with the ed school when I was at Harvard. So what I've learned about it is you can do all you want in D.C., but at the end of the day, these issues we have in the state of Texas, a good example, have to be dealt with to a great extent locally. Okay, good junior college with trade skills. Poverty in Dallas, as you just said, is unacceptably high. We need to address it. Ain't going to be done from D.C. It's got to be done by local leaders stepping up, and all of us stepping up and saying we're going to do something about it. And the reason we're struggling in the United States is because it requires local leadership. And I'm talking business people and philanthropists and people spending their time. What I'm noticing is I think actually Texas has got a lot of great initiatives, and Houston naturally has got a lot of challenges, but the local leadership's playing a big role there. We've got a lot of work to improve in Texas, but the leadership, I'm encouraged, the leadership and the reform that we did a few years ago at the state level, I'm optimistic. What I'm worried about is 45 states in the United States are losing population, or population growth is flat to down. We're bucking it. We're going to be fine. We've got plenty of money for this. We'll get this right. But if you're in Illinois or you're in California or you're in Connecticut, I would argue they don't have the money for it, and they may not have the business leadership that's getting involved and acting like owners. And so it's very uneven in the United States. And so it's a big challenge. I would love to see the administration talk more about it. I'd love to see all of us. I have to do more. We all have to do more. You probably can't do enough to personally get involved in this, not just in Texas, but around the country.
Yeah. So talk about state of Texas passing the voucher program. Thoughts on that passage? And
so my only worry is the following, and I will stay away from the politics of. You pick the percentage. 90% plus of students in the state, whether you like it or not, are in public schools. Got to get vouchers. Do I have for it? I won't even get into it. You've got don't let that fool you that you got to get public schools right. We need to attract teachers. We need to have good principals, superintendents. We need to help them improve. There's no getting around it.
So, what would you do today? What would be, if you were in charge of the education system, what would you do if you're Secretary of Education? What happens?
Well,
What's the first thing?
I've had conversations in the state and with mayors and at the, if I had an extra dollar, what would be the number one thing?
Yeah.
Education. Now, at the trickier part, which I can't even begin to answer, this isn't going to be mandated by DC and what is DC doing, and that one's tougher. I'm afraid what's going to have to the DC should jawbone this. We should have models in the United States. If we're doing, for example, we have child poverty action lab here that's outstanding. A number of states we notice are starting to look at it and want to say, can you help set up this backbone organization? Commit, I can tell you a number of states are looking at. And so you want to spread these around the country, publicize them. I think from Washington, you want to talk about some of these initiatives. I guess if they're sending education from Washington to the states, the question will be, is that with a lot less money than they're getting or more money? Be tough. You can be tough on teachers unions, the very controversial. So I'm okay with that. But this has got to be, if you're president of the United States or governor of a state or mayor, this has got to be in your top 3 topics. I'd be talking about it every single week. In the same way, if you're a CEO of a company, human capital, human capital, human capital. There's not a week. I've been back at Goldman for over a year. It's not a week we don't talk about human capital.
It's funny. You bring us full circle because you talked about the best talent at the beginning. In a lot of ways on the education side, it's recruiting and attracting the best talent to teach the kids to enable them.
And you need the money. And so to get somebody to work in a kindergarten teacher or childcare, what a lot of people say, the pay is terrible. You got to increase the pay. There's no getting around it. This is where I'm afraid the business leaders, we have to step in and say, government can't afford it. This is a worthy initiative. We'll help make sure that there's proper comp and we attract the talent. And there are efforts to do that, but that's where I think private sector more and more in our lifetime, that includes the nonprofit sector, is going to have to step up and do work, because we just went through saying government's it's over leveraged. I mean, we got to stop. We've been very blessed. We made a lot of money and done well in our careers. We have to step up.
Last question for you. I'll go to the personal side. Illustrious career, still ongoing. What have you learned? Give me 2 takeaways.
Still, the most important thing in my life, my mother lived to be 95. I try to teach this to my kids. Most important thing, if you get in a bad mood or you're depressed, you're feeling kind of lousy, go out and help somebody.
Mm-hmm.
Yeah.
Right? Do something for somebody else. Purely selfishly, you're going to feel better. The world needs it. And I think that's a secret that a lot of people have figured out. I think you guys have. I know Tom has, and a lot of people have not figured it out, and they have a dull headache and they don't know why. But the world needs leadership and needs all of us. My mother, till the day she died, I can tell you, wanted to help add value to the world. She wanted to make a positive impact. There will not be a day on this earth that you don't want to do that. And that's still the guiding light in everything that I think I do.
Rob, thanks for being with us.
Great to be with you guys.
I think this entire conversation shows the success that you've had in your career, but more importantly, why you've had that success.
Mm-hmm.
As I started out saying, it's pretty impressive. Not only have been in 3 different areas and contributed to our society and our economy in all those 3, but have been at organizations that were at the top of those, and you ended up being at the top of each one of those. It says an awful lot for the skills of leadership, which we've heard today.
Well, coming from you, that means a lot, because you both have had a lot of success, and you've been a great role model to me. So thank you for all that you do.
And I would also say one thing you said is corporate leaders need to come get involved in the communities. Yeah. It would have been easy for you to come and focus simply on the Fed when you came from Boston. You never did. You engaged in everything, not just Fed-related, but education and those sorts of things. This place is a whole lot better because of it. Thanks for being with us.
Thank you. Thanks for all you do.
You're biased, but I will tell you, Gerald Turner and the run he had at SMU, that's about as good as any college president in the last 100 years.
Well, being an alum, it's just remarkable to see SMU come back from somewhat of the ashes of the death penalty in the 80s, and then Turner took over in the 90s, and then he's had a remarkable run for 30 years that has transformed the school, both from a real estate perspective to an R1 research institution, and obviously the ACC with athletics.
It was interesting listening to the stories, but I'll tell you what I probably got more out of it was a view of leadership and how you accomplish things when you don't have all absolute power and its influence.
Well, Tom, when you and I talked about him, we've talked that he's the university president, and he really doesn't have a ton of hiring and firing decisions. He's got to be an organizer of people. He's got to empower and embolden his people to go lead well, and that's what he explained in that episode.
But more and more, that's what it's going to be in the corporate world, too. Yeah. It's going to be a question of influence and persuasion as opposed to absolute control.
Absolutely.
Great lessons from him.
Yeah. Wonderful episode. Tune in.